Hello everyone. Today we will discuss a very important question. It is a question that every investor, new or experienced, asks. Should we buy stocks when the market is going up, or is it better to buy when the market is going down? This is a puzzle that many people try to solve. They want to find the perfect time to invest their hard-earned money. They look at the market every day hoping for a sign, but is finding this perfect moment even possible? Let's explore this interesting topic together and find out what is the best strategy for you. The US stock market is a topic of great interest for many Indian investors. Why is that? It is home to some of the world's biggest companies like Apple, Google, and Amazon. In recent years, we have seen the US market go through many ups and downs. For example, 2023 was a strong year with the S&P 500 showing great returns. Then, 2024 brought some volatility, with periods of uncertainty. Even in early 2025, we are seeing the market react to global news and economic data. This constant movement makes investors wonder about the right entry point. For Indian investors, this is even more important as they look to diversify their portfolios internationally. So what should a new investor do? When you see the market reaching new highs every day, it feels exciting. This feeling is often called FOMO, or the fear of missing out. You see others making profits and you want to join in, but this can be a dangerous trap. Buying at the very top of a market cycle, also known as a market peak, can lead to losses if a correction happens soon after. It is like buying a ticket for a train just as it is about to leave the station at full speed. You might get on, but the ride could be bumpy, and you might have paid too high a price for your ticket. This is where the concept of market timing becomes so crucial. Many experts and new investors alike try to time the market. This means they try to buy stocks at their lowest price and sell them at their highest price. On paper, this sounds like a brilliant strategy. Who wouldn't want to maximize their profits? However, in reality, it is extremely difficult to do this consistently. Even the most experienced professionals find it nearly impossible to predict the market's exact movements. For a new investor, trying to time the market can be a recipe for stress and potential financial loss. It is better to understand the fundamentals first. When we talk about investing, we must talk about the great Warren Buffett. He is known as the Oracle of Omaha for a reason. His wisdom has guided investors for decades. One of his most famous quotes is, "Be fearful when others are greedy, and greedy when others are fearful." This simple sentence holds a powerful lesson about market timing. It suggests that the best time to buy is not when everyone is celebrating market highs. Instead, it is often when there is pessimism and prices are low. He advises against buying into the hype and excitement of a booming market. Let's look at a real-life example of Buffett's strategy. Recently, his company, Berkshire Hathaway, has been making some interesting moves. He trimmed his position in Apple stock. Why would he do that when Apple is such a fantastic company? He likely felt that the stock's price had run up significantly, and it was a good time to book some profits. He was not selling because Apple is a bad company. He was simply managing his investment based on its valuation. This action shows a disciplined approach, not an emotional one. He is reducing his holdings when the price is high, which is the opposite of what many new investors do. On the other hand, let's consider his investment in Bank of America. Buffett has been a long-term holder of this stock. He often increases his stake when the banking sector faces uncertainty and stock prices fall. He understands the long-term value of the business. So, when others are selling in a panic, he sees it as a buying opportunity. This is a classic example of being greedy when others are fearful. He is not trying to catch the absolute bottom. He is buying a good business at what he believes to be a fair or discounted price, with the intention of holding it for a long time. These examples from Warren Buffett provide a clear lesson for us. He does not try to predict the market's next move on a daily or weekly basis. Instead, he focuses on the underlying value of the companies he invests in. He buys when he believes the price is reasonable or cheap, and he sometimes sells when the price becomes very high. For new investors, the key takeaway is to focus on quality companies and not get carried away by market sentiment. Avoid the temptation to jump into a rising market without doing your homework. It is a much wiser path. Now let's talk about the other side of the coin, investing when the market is down. When stock prices are falling, it is often called a market correction or a bear market. Logically, this should be the best time to buy stocks. Everything is on sale. Imagine your favorite store announcing a 30% discount on everything. You would rush to buy, right? The stock market is similar. A downturn means you can buy shares of great companies at a much lower price than before. This presents a wonderful opportunity to build wealth over the long term by accumulating assets cheaply. However, there is a big difference between a sale at a mall and a sale in the stock market. The difference is emotion, specifically fear. When the market is falling, the news is often filled with scary headlines about a recession, job losses, and economic problems. It feels like the world is ending. Seeing your portfolio value decrease every day can be very painful. This fear causes many people to do the exact opposite of what they should. Instead of buying, they panic and sell their existing investments, often at a loss, to prevent further declines. This fear is a powerful psychological barrier. It is what prevents most people from taking advantage of the opportunities a down market presents. It is very hard to invest your money when it feels like the market will continue to fall forever. You might think, what if I buy today and it falls even more tomorrow? This thought paralyzes many investors. They wait for a clear sign that the market has hit the bottom and is starting to recover. The problem is that this sign usually becomes clear only after the market has already risen significantly from its lows. So, while investing in a downturn is smart in theory, it is very difficult in practice. It requires courage, discipline, and a long-term perspective. You must be able to ignore the daily noise and focus on your long-term financial goals. It means having faith that the economy and the market will eventually recover, as they have always done throughout history. Understanding this psychological challenge is the first step to overcoming it. You need a plan and the conviction to stick with it, even when it feels scary to do so. What if you wait for that perfect market correction? What if you decide to stay in cash, waiting for the ideal moment to invest? This strategy is also very risky. The danger is that the perfect correction you are waiting for may never come. Or it might be much smaller than you expect. While you are waiting on the sidelines, the market could continue to climb higher and higher. By the time you realize you have waited too long, you may have missed out on significant gains. This is a common mistake that costs investors a lot of money. Let's look at the S&P 500 data. History shows that the stock market's general direction over the long term is up. There are, of course, many downturns along the way. But if you had invested in an S&P 500 index fund at almost any point in history and held it for 10, 15, or 20 years, your investment would have grown substantially. The short-term volatility becomes less important over longer periods. Time in the market is almost always more important than timing the market. Trying to perfectly time your entry often means you miss some of the best days in the market, which can severely impact your returns. Think about it this way. If an investor had put money into the US market at the beginning of 2023 and simply held on, they would have seen excellent returns, despite the volatility in 2024 and early 2025. Another investor who sold in fear during a dip in 2024 and waited for the perfect time to get back in might still be waiting, having missed the recovery. For us in India, accessing these long-term opportunities is now easier than ever. Modern apps like Appreciate allow us to invest in US stocks and ETFs smoothly, making it simple to build a global long-term portfolio right from our phones. In conclusion, the debate over when to buy stocks when the market is up or down misses the most important point. For most people, the best strategy is not to try and time the market at all. Instead, it is to invest regularly and consistently over a long period. This approach, known as systematic investing, allows you to buy more shares when prices are low and fewer when they are high. It removes emotion from the decision-making process and harnesses the power of long-term growth. So the best time to start investing was yesterday. The next best time is today.